And also looking ahead to the Walt Disney Company. Next week, it's set to report earnings. We see the shares up about 1.5% or so today. There is a lot going on when it comes to Disney, from the parks around the world. Remember, we just had reports of Shanghai Disney being shut for a bit because of COVID there, to the streaming landscape here in the U.S. A lot to consider. And considering all of it is our Alexander Canal, who's here with us on set. Hey, Allie. So what's the sort of big picture numbers you're going to be looking for?
Well, clearly we learned a lot from Warner Brothers Discovery and Paramount when it comes to the state of the market right now. Obviously, the weakening ad market impacting their bottom line. I expect that to happen to Disney a little bit, but this company has a lot of levers to pull. I spoke with Tim Nolan from Macquarie. He reiterated his outperform rating earlier this week. He said it's weird having a buy rating on a stock that's down more than 30% year to date, but he did note that over the long term, this company has a lot to look forward to. What you're looking on your screen now is a Wall Street projections. Revenue expected to come in at $21.27 billion, adjusted EPS of 51 cents, parks, experiences, and consumer products revenue at $7.59 billion. But a really important number is that operating income, $1.9 billion is the expectation. That's less than what we saw in the third quarter, but we could see a little bit of an impact from Hurricane Ian there, perhaps some of that Shanghai Disney closures, and then those Disney Plus subscribers expected to come in at 9.35 million. Now, what Nolan told me to watch is that direct-to-consumer subscriber figure. Like I said, 9.5 million expected, along with that ad tier expectation. How will that add to the company's bottom line? Nolan estimated that ad revenues could surge up to 800 million in 2023, thanks to Disney Plus. That's sort of the overall market opportunity there. And then on the park side, you want to make sure that gross bookings aren't going down, that there's no recessionary impact. The analyst pointed out that in 2009, the last financial crisis, park revenue fell 7%. But there's a bit of confidence that won't happen in 2023 due to increases to prices, updates to the park, the Genie Plus app, et cetera. And then finally, the impact of that advertising slowdown. ESPN, I think, is pretty insulated from all of that. But ESPN, another big question, right? Looking forward to the company, what's the DTC future of this? Because right now it's clearly more profitable in a linear world than it is in an OTT world, but something that Bob Chapek will have to think about as well.
I think there's just too much optimism around Disney Plus coming into the report. And keep in mind, this comes against a backdrop. Look, we heard from Roku this week, a major slowdown in their business. Netflix, probably some squishy areas in its quarter as well. Paramount Plus now looking to potentially lay people off. It hasn't been a good look in streaming.
Hasn't been a good look in streaming, but Disney is not just a streaming company, right? They have a lot of different components to the business, and there's a lot of confidence that they can enter this new world and be very successful at it. If you think about advertising, Disney has a really good base in this. They've really crushed it with Hulu. They have the experience on the linear side. Unfortunately, that ad slowdown, there's not much you can do with that, right? There will be some overhang there. It will cloud the outlook overall. But overall, I think they're in a good position. They made a lot of investments to Disney Plus. We have a lot of exclusive content that's coming to that service. Disenchanted, one of the ones that I'm very excited about that's coming. And I think that content spend is going to slow down significantly over the next few quarters and the next few years, and that's going to positively impact EBITDA. So a lot of macro concerns, but I think for this company, they're in a really solid position moving forward.
And also with Disney, there's the consideration that on the streaming side, too, we could see some more focus around ad tiers at a time where Netflix is rolling out and pulled forward the timeline for themselves to launch that. And so now that we've started to see that pop up in the market and perhaps see what some reception looks like, how have the early days been for Netflix?
Well, Netflix just launched their ad tier in the U.S. yesterday, a $6.99 price point, slightly below Disney Plus's upcoming ad-supported tier at $7.99. It's going to be a wait-and-see approach. We're not going to have all the answers this quarter. I think it's going to take a few quarters so we can really see that impact. I do think across the board, streamers have been exploring price increases. Warner Brothers Discovery on the earnings call last night, they actually pushed up the timeline for that combo service between HBO Max and Discovery to the spring. They said there's a lot of options with pricing, sort of hinted that price increases will be coming there. And so pricing is something to really focus on when we think about all of these streaming giants. And I think that's a big component that's going to be important in the quarters to come.
Looking forward to Disney.
Woo!
Thanks
Let's
so
get
much,
it.
Allie. Appreciate it.